business, I'd like to take this opportunity to introduce our first speaker today. It's Hannah Edinger, the Associate Director of Africa Insights in Deloitte and Touche, who will be walking us through the macroeconomic view. Thank you very much.
Good morning, everybody. Thank you, Matt, for introducing me, and thank you, Minister, also for your time here. As mentioned, my name is Hannah Edinger. I've traveled today on this beautiful Heritage Day that we observe in our country, in South Africa, to be with you here in Addis, and super excited to be here. Always love coming back to Ethiopia, and certainly wonderful to see how this country is developing, the opportunity and the potential that we're seeing on the ground. Fascinating, lovely to be back. So quickly, I've got the difficult job of, I was told, 30 minutes and to take you through Africa. So I'm going to run through some slides. I've got my running shoes on to do so, and really want to focus on three key areas today. One being looking at the growth outlook. Particularly, there is no such thing as one growth outlook for the continent. We all know that Africa is made up of 55 different individual economies, so I want to talk a bit about the multi-speed growth outlook for the continent. With what's happened over the last few weeks, the last few months, particularly the signing of the African Continental Free Trade Area Agreement, and some of the infrastructure investments that are happening in this part of the world in particular, I want to speak to, and linking to the growth outlook, a bit more of a connected Africa and what this can mean for Africa's growth fortunes going forward. And last but not least, I want to talk about demographics with a number of slides, graphs and maps illustrating what is ultimately the biggest asset that this continent has, our people. So quickly looking at the growth outlook, and I don't want to spend too much time on the global economy, but I think what we are seeing, if you're looking at forecasts by the IMF, by the World Bank and others, if you're looking at the G2 economies, the United States, if you're looking at China, but also a number of very important manufacturing-driven economies such as Germany, in Europe, we are going towards a very much synchronized deceleration in growth at the moment. The good news around Africa, even though the Africa Rising narrative certainly has changed over the last 5 to 10 years, and as mentioned, there's no one Africa Rising narrative, perhaps. The good news is that after developing Asia, sub-Saharan African region is still the second fastest growing region, which will be accelerating to about 4% over the next 4 to 5 years. Mind you, what happened back in 2014, I think a number of us did not expect for oil prices to more than halve back in 2014. Nobody at the World Economic Forum meeting in Abuja asked what happens to Nigeria, what happens to Angola, what happens to the growth trajectories of a number of commodity exporting economies in Africa if oil becomes half price or a third of its price, if commodity prices once again decelerate. And I think part of where we are, and the oil price in particular is a case in point, is as Africa, we are price takers. We are not price setters. And we are in a particularly difficult and certainly very uncertain global economic environment at this day and age. Certainly uncharted territory for policymakers. Think about the Fed, for example, in a number of major jurisdictions. Some of the current global risks or headwinds, if I may, I've listed on this slide. And perhaps a couple to point out here is, and to me, this is something that I've been tracking for the last few years, is this new normal that we're seeing in China as China transforms, as it modernizes, as it moves up the value chain, something that has been coming for a number of years already. It's moving from this leading producer to a leading investor to a leading consumer globally. As this transformation has been happening, China's GDP growth has slowed from what used to be 10% over 3 decades on average to currently 6.5, nudging or lowering now closer to 6%. Mind you, in our part of the world, in South Africa, 6% is something we could only strive towards. If we're lucky, we will be growing at 1% this year. So we've got this new normal in China, which certainly has impact for commodity producers. It has an impact on commodity prices. But I think very importantly are the uncertainties that are happening in the United States, the policies under Donald Trump, and linking to China in particular, the US-China trade war and the imposition on tariffs of Chinese exports to the US. But also the rate normalization cycle that we're seeing in the US, the impact of Brexit. Quite frankly, I don't know, and I don't think anybody knows what the true impact of Brexit will be. And generally the rise of populism and anti-globalization. Maybe just to go back to 2007 it was. In 2007, only 3 economies did not grow out of the 183 economies that the IMF tracked. It was Fiji, it was Zimbabwe, and it was the DRC. 114 countries grew at more than 5%. You had to really, really try hard not to grow. That was more than 10 years ago. Very different global macro that we are in now. 3 things really supported that growth outlook back then. It was easy money, it was a cheap China price, and the last thing, perhaps a little bit less tangent, confidence. So going on to, with what I've said, the changes that we are seeing, particularly coming out of China, the greater uncertainty that we are in the global economy is that, and this is certainly very relevant for our part of the world, particularly for commodity-producing countries in Africa, is that there's no return to the boom years for commodity producers. Emerging markets generally as well are experiencing weak growth, and African commodity producers are no exception. I want to talk a bit about the 55 countries that make up the continent. There is no such thing as one Africa. In South Africa, we often talk about, here at Santon boardrooms a lot, we need an Africa strategy. We need to go to Africa, as if we're not already there. As if the Limpopo River in our part of the world was the Indian Ocean. But mind you, Africa is a highly fragmented continent. We can look at, we had the Minister of Culture and Tourism here, just the number of languages and ethnicities, more than 1,500 languages and dialects, highly diverse culturally, from a territory, from a climate perspective. It's also very concentrated from an economic perspective. 9 countries make up 3/4 of GDP. 5 countries make up 2/3 of consumer spending. If we look at the 55 countries, again, we've got a number of very, very small economies. Half of them have a GDP of less than $10 billion US dollars. 20 countries have populations less than 5 million. If you look at Ethiopia, for those who don't know, Ethiopia is the 2nd largest population in Africa at more than 100 million people. So a highly fragmented place, maybe something to mention as well, given that I want to talk about connectivity. 16 countries are landlocked and do not have direct access to ports. But I think what I want to look at, if I at least group these countries by region, Ethiopia stands out as one of the shining stars, the beacons of light in terms of growth for the last decade, having achieved an annual average of 10% and double-digit, ultimately, GDP growth. And East Africa has certainly sort of separated itself almost from the rest of the continent. Mind you, as Africa, we're not really integrated with ourselves. If you look at our trade statistics in particular, from an export perspective, only 16% of what we export is to each other. We trade around the perimeter. We don't really trade with each other. And this is very much driven through a resource-driven, commodity-orientated business model. But before I speak too much about some of my other slides, what I really want you to take away from here is that East Africa, looking forward, will continue to be one of the fastest growing regions over the next 4 to 5 years at above 6%. If you look at Southern Africa, for example, certainly a laggard in terms of the growth trajectory that will nudge about 4% for Africa in the next 4 to 5 years. So East Africa is almost diverged from the rest of the continent, as mentioned. It's less tied to commodity price fluctuations. It's seen high and stable growth for more than a decade, and a lot of that has been underpinned by the development model that is focused on high growth fixed capital formation. So I've taken out a couple of countries. East Africa here is Eastern Africa is the blue line, a couple of select Western and Central Africa, Sub-Sahara average, as well as South Africa. And just to show you that the blue line on the right-hand graph, East Africa over the last decade or so has invested quite highly in gross fixed capital formation, i.e. infrastructure spending. If you look at a country such as China, part of China's developmental success over the last 30, 40 years has been, amongst other things, linked to high levels of infrastructure spend as a share of GDP, nudging above 30%, nudging almost 40% on a continued basis. If there's one region in Africa that's been following a similar investment drive in infrastructure, it is East Africa. And the rule of thumb really is if you're investing 30% or more of GDP in infrastructure spend, your economy creates, or you are creating the foundation and the enabling environment for your economy to grow. There is growth suppression in a number of countries. After a lot of work that has been done, particularly since the turn of the millennium, the turn of the century, in reducing debts, really around money ultimately not being invested in productive sectors. But let me not spend too much time on this. I want to talk, given the short time that I do have with you, a bit about a more connected Africa. So linking to the resource-driven growth model that I have already alluded to, my message in this section, and as part of hopefully the talk that you'll take away, or what you'll take away from my talk today, is our business models as economies of this continent need to change. The commodity-driven ones are old, they are dated, they have not trickled down to the greater populace, and with Africa having more Africans, there will be more Africans than Chinese by 2025. Economic transformation, diversification of this continent, of our regions, of these economies need to happen. We, as mentioned, we are price takers. We are over-reliant on what happens to commodity prices, and these shocks are detrimental to the growth outlooks or the growth of a number of economies. Think Nigeria, Angola, that's been in recession, etc. Map the commodity exports as a share export of a number of African countries, most in fact, on this. And you will see that on the right of the light blue line, commodity exports account for more than 80% of merchandise exports in one of 3 African countries. This is not sustainable. Our structure of exports has changed much over time. Over the last 1.5 or so decades that I'm showing here, we continue to be competitive only in commodities, if you look at the external sector. What has, however, changed are our destinations. We still continue to trade more with the rest of the world than what we trade with each other, but since 2009, China has actually become the largest trading partner of the continent. And here, this shows you the different export destinations. Mind you, what is really exciting in terms of the research that has been done is that when we do trade with each other, according to the research by UNECA, the United Nations Economic Commission for Africa, when we do trade with each other, our trade isn't only resource and commodity based. There's greater value addition, there's knowledge sharing, etc. So there is this premise, there is this need for us to actually do more business with each other in the continent. I know that a lot of you here obviously probably would want to hear a bit more about tourism and perhaps the services sector, but there is no other sector in the world and in economic history that has created jobs, that has been able to foster regional value chains, supply chains, creates the sharing of knowledge, skills, technology transfer, etc., and the embedding of intellectual property as manufacturing has. And that is the one sector that we won't be able to just leapfrog in this part of the world. And we've actually been deindustrializing, apologies, over the last few years. We've been struggling to raise our manufacturing output as Africa, as a share of global, the last 3 decades from 1%. If you look at manufacturing value added, it's only about 10% on average, as this graph shows. In China, manufacturing value added is 44% of GDP. In other Asia, it's above 20, sometimes above 30% of GDP. So too in Latin America. This is a sector we need to get right, ultimately, for us to grow and to prosper. And I think the African Continental Free Trade Area Agreement that came into force end of May this year is Africans saying, yes, we want to do this, and we want to do this together. We ultimately want to connect more with each other. We want to trade more with each other in a world where there has been rising anti-globalization sentiment. It will come into force, or it will become operational if everything goes to plan mid-next year. Mind you, there's a lot of work to be done, and the benefits will not be immediate. But I think it's the intent, the will, and the vision that we have as a continent to achieve our 2063 goals that makes this so important. It will connect 1.2 billion people. It will create a market of at least 2.5 trillion US dollars. And this just shows you some of the benefits from particularly looking to reduce tariff-related barriers to trade, but also non-tariff-related barriers to trade. It is estimated, and these are very conservative estimates, that this will double trade with each other over the medium to long term. It requires, as mentioned, reducing barriers to trade. Mind you, over the last 15 or so years, doing business in Africa has become much easier than it was 15 years ago. But if you look at any indicators, ease of doing business, the global competitiveness rankings, etc., there's still a lot of work to go to make us more competitive, to attract investment into different sectors, including manufacturing, tourism, etc. And often it's the basics that are not there. The basics to becoming or to having a more enabling environment. Here are just some of the comparatives. Only 53%, one indicator, of roads across Africa are paved. We need to get the basics right still to be able to compete internationally. I won't look at that too much, or the losers too much, but certainly from a winning perspective, the AFCFTA and the greater interconnectedness between our economies has certain benefits, not only from a job creation perspective and building small businesses, but certainly also attracting investment, as mentioned, IP, and building our manufacturing sectors as well as productivity. One of our biggest challenges to this and to doing more business with each other is our limited physical connectivity. At Deloitte, we have a publication called the Africa Construction Trends Report, which every year we track projects, including hotel projects, that are $50 million or more, and they must have broken ground 1 June of a particular year that we track. Here we tracked 482 projects that were in excess of $471 billion US dollars. And I think the exciting thing about these projects that we are tracking is that they're happening in the right sectors. Sectors that will enable other economic activity. They're happening in energy and power. You can't industrialize if you don't have energy and power. They're happening in the transport, ports and shipping sectors, and they're happening in the real estate sectors. Industrial, commercial, residential real estate. Mind you, if you look at estimates in terms of how much investment is needed in infrastructure, recent estimates by the AFDB have actually doubled. And the gap that we need in terms of funding infrastructure and to connect ourselves to each other better is actually much bigger than what we had previously anticipated. And I want to bring China into this conversation, in East Africa in particular, but certainly in other parts of the continent as well. You can't talk Africa without talking about China. China's Belt and Road Initiative in particular, and the link to East Africa, the investment in supply-side constraints, eliminating infrastructure, rail, think road particularly, linking to this East Africa Railway Master Plan, amongst others. China has been integral to infrastructure financing as well as building in the continent. I think this slide, I don't know how clear it is for you, but the same report that I mentioned earlier, in the 2018 edition, just highlighted for us again how integral China is right now in terms of the projects that are being built and funded in the continent. If you look at the continent at large, 1 in 5 is funded by China, 1 in 3 is built. If you look at East Africa in particular, very much more acute. 1 in 2 projects are built in China, 1 in 4 is financed by China. And I mean, I've been in this field for a long time, and over the last 10 or so years, it was all about, China's coming to Africa to take our commodities, to take our resources, et cetera, to fuel its own development. The story has changed. And I feel there is a unique opportunity, and Ethiopia to an extent is already capturing it. Well done. South Africa, not really at all. In terms of what's happening in China, but also what's happening between the China and the US. Give me a moment to explain. In 2012, former chief economist of the World Bank, Professor Justin Lin, estimated that with the changes that are already taking place in China, think rising wages, the move to more value addition, manufacturing, high-tech sectors, etc., the move away from being this low-cost production center will mean that a number of these jobs, these opportunities, these firms ultimately will be offshoring from China. Just like what happened to Japan in the 1960s, what happened to South Korea in the 1980s, will now happen in China, but at mass scale. Justin Lin then estimated, mind you, this is already 7 years ago, that over the next 10 or so years, 85 million jobs will offshore and leave China. Not 85 million Chinese, 85 million job opportunities. These companies will look for more competitive manufacturing destinations from a cost perspective. With Africa having the largest working age population as of 2034, overtaking India, we certainly increasingly are becoming more and more fit for purpose in an age where the working age population is aging, and it's ultimately an asset to have this working age population. If 10% of those 85 million jobs were to be attracted to Africa, we would ultimately double our manufacturing employment. Ethiopia has been capturing some of those jobs. Rwanda is looking at capturing them. Senegal is capturing some of those jobs. Think about some of the special economic zones of Chinese investment that have come up here in Ethiopia and in other countries. Long story short, China and this offshoring is now being accelerated with the policies that are coming out of the US. And a lot of this manufacturing investment, think US multinationals and the supply chains are moving to other parts of Asia, particularly Vietnam. But others, particularly with this uncertainty around tariffs, are looking at markets that have access, duty-free, quota-free access to countries such as the United States, Africa, those markets. I am conscious of time. This just shows you in terms of some of the FDI trends, despite the third consecutive year in terms of global FDI dropping, Africa has seen an increase. Most of, and I think this is what's really exciting, most of the greenfield FDI projects that have been announced are in the manufacturing sector. The top 10 investors, even though we receive a lot of investment still from traditional economies, you'll see markets such as China are coming in from a foreign direct investment perspective, not only concessional financing perspective. And the top 5 markets that are attracting FDI, as mentioned, include countries such as Ethiopia, South Africa, Egypt, Morocco, etc. With 5 minutes to go, I want to speak very briefly, and I'll reduce perhaps my slides just a bit, about the demographics and the African consumer. And I've already hinted to, by 2025, there will be more Africans than Chinese. 2034, we will have a bigger working age population at 1.1 billion people in this continent right here than China has, than India has. Our demographics are really the biggest asset that this continent has. Not what's in the ground, but what's above. 1 in 6 people at the moment comes from Africa. 1 in 5 will be by 2025. 1 in 4, so 1 out of every 4 people you meet globally will be African by 2015. And what's important is that we've got quite rapid population growth in the continent, and our economies need to grow at rates that are faster than this population growth. Otherwise, per capita will ultimately be getting poorer. So the key things that I would like you to take home in terms of the demographics and the African consumer, and I'm sure my slides will be shared with you afterwards to look through some of the maps that follow, is these positive trends are likely to be driving general economic growth in Africa going forward, being unprecedented population growth. I've already mentioned some of the numbers. I think another key asset is the youth. Our youthful population, with over 2 million Africans are aged between 15 and 24 years. This is expected to grow by more than 50% again by 2030, and bringing us to having the largest working age population. The other key thing is urbanization, and quite rapid urbanization. Think about moving 200 million people from rural areas to cities over the next 10 years. Well, that's going to be happening in this part of the world. If you look at developed markets, there's usually a 80-20 sort of split, 80 urban, 20% rural. We still have quite a long way to go in terms of those numbers. And I think importantly to sectors such as tourism as well, and to connecting with each other generally and producing things that the rest of the continent demands from a consumer perspective is a growing middle class. Particularly household consumption has been growing faster than GDP over the last year, and the broader middle class is estimated to be around 500 million people by 2025. At the moment, some of the better estimates estimate that this middle class is only about 300 million out of a continent of 1.2 billion. So we certainly still have a long way to go to raise incomes, to raise living standards, etc. But I think what's important is they're optimistic. This middle class is brand aware, but it's very much concentrated at the moment in a handful of economies. Last but not least, and linking to demographics, linking to consumerism in our part of the world, is the role of technology. And I haven't really talked about it yet, but if you think about it, more than 50 countries have more than 442 tech hubs in this continent as we speak. We have unique platforms, think payment platforms, ride-hailing platforms that are in excess of 200 innovations coming out of this part of the world. With the onset of the fourth industrial revolution, mind you, some parts of our continent are still in 2IR, you could argue, and not 4IR. If we're able to couple technology, skills, and education with what is youth bulge, this worker bulge that we have, we can ultimately translate our biggest asset into a demographic dividend, because the worst thing that could happen is that they become a demographic burden. I thank you for your time, and there are some more slides which I'm sure the organizers will share with you. If you have any questions, happy to take them, or for you to engage with me directly. Thank you.